Good evening, folks. Hope everybody's doing well. So we're going to be talking a little bit about some unfolding truths. So obviously we had 2 live sessions this week in a week that had FOMC, which is behind us now. Last day of trading tomorrow for the week. And ICT will be away from that, at least from the social media perspective. I'll be working with my son in private tutoring. So I kind of want to talk a little bit about something. I saw, I think it was a thread other people were replying to, and someone had added my handle on Twitter to it. Something to the effect that a viewer that still follows me on Twitter mentioned that the best thing in the world they could have done was, stop adding all the ICT stuff to their analysis and such. And it became a lot easier for them. And my takeaway from that is they stopped putting everything I talk about in their analysis. And I've said this many times, in the lectures. I've talked about how I have a lot of tools, I have a lot of concepts and processes, but not all of them are applicable. And over time, you'll see the ones that meet the criteria that you want to adopt for your model, for your approach to trading. And not all of the tools that I implement and teach and present to all of you are going to be useful to all of you. They won't resonate with you. And I've made that very candid point multiple times. So when I see that, and people come behind it and they'll say, "Yeah, this is you're spitting facts. This is nothing but truth. It's a truth bomb." Some of the replies were like, "Yeah, I can't get it to work for me. How long you been doing it?" "I've only been doing it for 2 months." Okay, well, there's your answer. The things I want to talk about tonight are simple truths that I'm showcasing. I'm doing it daily with you, either in Twitter or now the live streams. And it's basically, me pulling back on the information that I've already talked about in my lectures. So now you're getting to see it live. So there's no argument now. There's no question whether or not it's actually happening in the marketplace, because we were able to sit here as a community live over the charts, and it happens to script on the time that it's supposed to happen. So when we look at the marketplace and we're looking for opportunities, I want you to take a second to kind of like put everything down in your mind that you try to reach for using my concepts or other analysis concepts. And the simplicity that's available to you, but you yourself are complicating, because I'm teaching various tools, but I'm not stating that these tools are applicable at all times, all time frames, every asset class. There's certain things that are useful that are not useful in other times. And in that thread that I saw, the person that was creating it mentioned that they stopped trying to put everything on every PD array. Well, not every PD array is in every fractal of price action. Not every single one of my PD arrays are in any one given fractal and price action. So in other words, if we were to randomly scroll through any particular market, someone could call out a market, and then someone else could call out a time frame, and then I load the chart up and scroll through randomly wherever it stops, the first 45 minutes of data on a lower time frame, say, okay, that's the segment price action we're going to look at. So everything would be randomized. Not every single one of my PD arrays would exist in that fractal, but the ones that do exist and reside in that price action inside that market structure, they're pertinent. That means it's something that you need to be considering. Whether or not you use it to trade with or enter matters not, because you understand, hopefully by now, that when I'm doing pyramiding, when I'm doing multiple entries into the same general trade, but I'm just building the position larger. For instance, you usually see me go in with 6 contracts, then 3, and then a final for a 10 lot. If I'm really aggressive, I'll do 6, 4, 3, 2, 1. Is it all the time? No. But I'm utilizing every available PD array so that way you can look at the examples I'm using. That would be a pyramid entry. That could be an individual standalone entry, and the other ones prior to that one may not fit you. So when I do these examples, it's meant for your edification so that way you can see which one resonates with you. I don't need to do a pyramid. I can just do one full pull and all in at one time and go all out at the terminus. But when I'm showing you the examples, I'm teaching you by example, real time, by going in, executing on live data, every possible pyramiding entry. That way you can see what they look like. Unfortunately, some of the viewers and students that are casual viewers really not trying to learn, they're looking at the pyramid examples and focusing on what would have been profitable in terms of the money. And that's unfortunate, but I want to try to show how you can take a equity base and run it up using the tools, the money management, the trade management, all those things coming together, and how you can really parlay any equity size up to enormous heights. Now, you aren't going to be able to do that right away. Someone in their first year isn't going to be able to do that. It's going to take some time looking at things. But what I want you to focus on is when I do those examples, and they're always made public, to look at each one of them in terms of where I entered, what pyramid entry did I do, what was it based on? Study it. Whatever one of the PD arrays I'm using in that example, does it jump off the chart where it says, oh, well, this is the one I always look for? Because sometimes I'll see students, they'll say, I got that trade, but I only used your second or third entry. I know what they mean, and they're doing it correctly. They're not trying to count the gains that was made on that paper trade. I'm not trying to inspire you with paper trading equity. I'm trying to inspire you to determine which one of the PD arrays are most important to you, because you're going to start with one of them. It doesn't mean it's going to be the last one for you or the one you're going to settle in on, but it's going to be the one you do the most work with until you find some continuity in reading price, and then you'll grow into maybe another PD array. They may not be breakers initially. It may not be the fair value gap initially. Unfortunately, I feel like I'm funneling you all into this fair value gap idea. And if I was being 100% honest with you, I am in a lot of ways trying to, because it's easy to see, it's visual. And when we look at price, hopefully by now, even the newer viewers and memberships to this community now can see that price is not random. If you think price is random, that to me shows me that you haven't been really paying attention. You're not listening. You're not looking at the examples, the executions, my students' executions. They're doing things that you see me teach from beginning to end. And I'm inspired and I'm thankful that they've put the work in, and they're showing their own individual community, the people that follow their YouTube channel or their social media accounts. And that feels good as a mentor because it's transferable knowledge. But just as well as price is not random, the manipulation that occurs in these markets is in fact very real. And sometimes we can predict when that's going to occur. Not all the time, but most times. And when we have weeks like FOMC we had this week, and when we have CPI and we have non-farm payroll, we have to adjust and adapt to the likelihood of unfavorable conditions for a short period of time. That is an unfolding market truth. It happens all the time. There's no ambiguity to it. It is absolutely something that repeats. But when there's no likely manipulation that comes by way of a high impact news driver like FOMC rate announcements or non-farm payroll or CPI, then we're more likely to see a medium or high impact news driver provide low resistance liquidity runs, which is the hallmark to what I teach as a mentor. Now, you see me engaging in high resistance conditions. That means I'm looking at markets that I generally would shy away from, not because I can't win, but because it's too much babysitting. And I may have to mitigate something that I did that didn't pan out well. I had that today. No harm, no foul. First trade out the gate, boom, no problem, done. Explained where the buy side was. I told you where the order block would be, and boom, took off. So that padded me out. Then I tried to build in a position, forcing an idea that I would otherwise try to do in another condition, not after FOMC the following morning. And it turned on me. Even though I tried to pyramid it and build it up, it stopped me out. No big deal. I said, okay, I'm going to reverse. That's not chasing, folks. Because if it's showing a willingness to not want to go lower, and we saw today the new week opening gap was offering support. I wanted to see it trade below it and offer resistance and then displace lower. And I was trading with that idea in mind. It ripped higher. Okay, no problem. I'm wrong. Stop me out. So now it's hanging around a mitigation block, not a breaker, a mitigation block. So I used that to get in. It rallied up after me telling you that it was going to go to that 40.26 and a quarter. I think it was 40.26 and a quarter, 40.26 and a half. I don't recall, but I know it's 40.26 to 40.28. And I told you it was a 5-minute gap that it was basically hinging on. And it blew up right up there, bang. That navigation, that turning on a dime, that comes with experience. You don't understand that when you're new. It feels like, oh, well, it's revenge. I saw a couple of guys say, well, you just revenge trading. That was not revenge trading. Number one, I did significantly less contracts after getting stopped out. And between the first win, the loss, and that final portion going up into that 40.26 level, the 5-minute fair value gap, no drawdown. So that frees me up to do what? Trade really where I want to be at in the afternoon. On FOMC, the day after, in the morning, all I'm doing is observing. I want to see what they're setting up for the afternoon. I wanted to see it trade back down in that opening range gap. But they just kept pushing and pushing and pushing all the way up into that 5-minute SIBI that it's framed around the 40. Let me see what notes here. 40.39 and a quarter. And you can find that on your 5-minute chart of ES for the June contract. I told you to mention that in your annotations on your chart and the fair value gap around the 40.26, 40.28 level, all 5-minute basis. So eventually The market started to peter out and trade softer. And I gave you a imbalance with a dealing range. It was that blue shaded fair value gap. And so I want to see it draw down in there after the lunch begins. That's noon time. Okay. And I'm going to talk a little bit about that in this discussion and why it's important to think like these protocols put you in front of your charts looking for these signatures to repeat, to come into the marketplace. So you're not reacting to price, you're anticipating. Now, one could say, oh, well, didn't you react to price when you reversed? And to a neophyte, that would look like chasing price or revenge trading. Revenge trading would have been doing the same amount or not that, but more contracts going long and reversing. That's revenge trading. I know it well. I did it a lot when I was a young man. But expecting it to trade back down into that opening range gap, remember the shaded area? It was like an orange or tan colored rectangle that I was drawing out this morning using the regular trading hours, yesterday's settlement price, closing price, to where we opened up at today's trading on regular trading hours. It's that gap in between. So that's opening range gap. That's not new day opening gap. That's the difference between 5 p.m. and 6 p.m. But those imbalances that are created with the opening range gap, it sets the tone for how we can trade intraday. So we can go into the marketplace anticipating a certain measure of symmetry in price. And when there's a lack of symmetry, meaning the indices are doing opposite things, they're not in agreement. One's going up a little bit, one's going down, one's just doing whatever it wants to do. That's not a symmetrical market. And we want to operate in a market that is just like this. This is for your notes, folks. If you're not writing this stuff down, I promise you, you will not remember this. You're not going to remember it. And it'll be wasted time sitting here listening to me just bloviate about something that I know how to do. My students that have been taking notes, they know this. But those of you that don't, you need to take this and transpose it into your journal. But you have to anticipate this likelihood of a disparity between where we closed the previous day and where we're going to open up at 9:30. Now, obviously, you can forecast it because the markets are trading electronically. And you can see, okay, we're going to be opening up with a gap higher or lower. But you're not going to immediately sell short expecting that gap to fill immediately. You have to anticipate some measure of continuation. What does that mean? Well, when we're looking at price, we know that it's not random. We know that manipulation is real. We know we can pretty much time majority of the manipulation. But we also understand that liquidity is a visible property in analysis. We don't need some kind of application, okay, like depth of market. There's a lot of names for all these things out there. And I understand that they may be useful to other folks, but I'm trying to teach you how to trade naked where there's no indicators, no reliance on some subscription service thing, no indicator-based idea. You don't need those things. And because liquidity is visible, meaning above old highs, it goes without saying. If you look at a book map or the ladders on depth of market, level 2 data, you're going to see numbers right above what you can see on your chart that would be an old high. How many times do you need to see that and know that, well, it's obvious. I mean, above that high, if the market has pulled away from that high recently, then there's liquidity above that. What kind of liquidity would that be? It would be buy side liquidity, buy stops. Someone's utilizing that area to potentially enter on a breakout going higher because they're bullish, or someone's utilizing that area to protect a short position. and shorts are protected with a protective buy stop. And we're not trying to differentiate or get the ratio of what amount of buying on a breakout or buying a short covering exit. We don't care about that. We just know that that's a market truth. Above old highs or a singular high, we are anticipating that there is going to be a draw to that eventually because there's liquidity there and it's visible. We can see it. That high is going to have liquidity above it. It goes without saying. Just as well as we can see that visually in price with old highs and old lows, because old lows, we would have sell side below that. Whether it be a singular swing low, an old low, or relatively equal or multiple lows. We know that below that is going to be a pool of liquidity in the form of sell stops, which we dub sell side liquidity. We don't need any indicator. We don't need a heat map thing, whatever these individuals that like to have all these tools and things. It makes you feel like you're high tech. I understand. I wanted to be like that when I was younger. I wanted to have every gizmo that was out there because I felt like if someone were able to see my charts, they would be impressed. Look at what he's got. Look what he's got on his chart. Whoa. Wow. Look at all that. Look at those GAN fans. I had all that stuff on there. It was nuts. But just as well as we can see the liquidity above and below swing highs and lows, and that's not rocket science, but it's amazing how people don't utilize that in their trading. They adopt some relief of, in my opinion, of not relief, why did I say relief? In some kind of a religious approach to an indicator. There's more emphasis on an indicator or an overlay of some kind than simply reading the chart itself and understanding where orders would be. So if we were to ask the question like this, is it more likely that a Gartley pattern, which is a harmonic pattern, it's pretty simple stuff, but some bullish Gartley pattern, is it more likely that the market's going to go up because the market traded into a Gartley pattern that would be bullish and going to its pattern target? Or is it more likely the fact that we traded down and there is a higher time frame order flow that's bullish, and it's clear that we had some manipulation on the downside and sell side has been taken? Then we're going to be looking for a counterparty to do what? Look for buy side. It's the second. The market's not aware of harmonics. It doesn't matter. There's no identification for that reference point in the algorithm. It is seeking where obvious levels of liquidity would rest. And if it's not doing that, it's doing what? It's seeking inefficiencies. That means fair value gaps, SIBIs, BISIs, something to that effect. Volume imbalances. So the market can see that. It can see old highs and old lows. It cannot see the number of orders above old highs. It cannot see the number of orders below old lows. It doesn't need to know that. Because human psychology, we're all being manipulated in the beginning when we first start trading. We all drink from the same tainted well. Put your stop above this old high. Put your stop below this old low. Buy on a breakout, sell on a breakout. Break and retest. Where's your stop going to go? Most recent swing higher, most recent swing low. That's Neophyte 101, how to lose money. And that's why the statistics are what they are, because you're all doing what I did too. Everybody that comes in this industry, if you buy a book or borrow a book or someone teaches you from a book, you're getting misinformation, and it's not fun to realize that later on. And sometimes you, like I did, I wrestled with it. I didn't want to let go of it. I was like, I'm just doing it wrong. I got to do it more. I got to trade harder. I got to push my edge and make it sharper. I haven't been trading enough. I just got to keep pushing. My stops are too tight. I got to make them wider. Don't use one. That's even better. And all of it resulted in blown accounts. So I know what it feels like to fall victim to all this stuff and what took place in my understanding about price action that prevented me from doing those things again. And it's the understanding and the market truth of how markets seek liquidity above old highs, below old lows. And if it's not doing that, it's going up into a premium to reprice to an inefficiency where price created a stibby, where it's only a down move. And it's going to reprice back up to that level again. Now, because those are the two most important pillars of understanding bias and narrative, it's very important you spend the majority of your time studying old price moves with that in mind, going through your charts, annotating who got hurt here, who was being targeted here, meaning you go through your charts and say, okay, at this price run here intraday on the morning session, whether it's Forex or whether it's futures, you're going to map out the chart with as much detail as you want to put in, but the better amount is try to be as detailed as you possibly can, way beyond what would be necessary for you to take a trade, because you're teaching yourself how to read what took place. You're placing, with the benefit of hindsight, looking at it, you're placing a narrative on what clearly took place. And by doing that for weeks and months, while learning how to read the draw on liquidity, read the tape, you're doing exercises in hindsight and you're watching me call it live and you're watching me outline it in live streams live. You're getting a complete understanding. You're doing drills and exercises by you going into the charts yourself. And then you're watching real time. You're hearing me. You're watching me point out things real time. And you're seeing things, whether you realize it right now or not, but you're seeing things repeat. And your understanding is growing. It may not be exponential right now. It may be very marginal, but it's increasing. And over time, your subconscious is going to be gleaning more and more each time that I'm doing it live. And you're going to remember, oh, it's like those 50 other times I saw that in my back testing and where I'm annotating and logging. I see that it's there. That's my thing. That's the thing I'm looking for. That's the model that your eye is going to jump to. Every single time the market creates it, your eye will go right to it. And you won't be looking for it. It's just your eye goes right to it. Boom, there it is, which is why I like to teach with the fair value gap. It's very easy to see it in the chart. It just stands out. It sticks out like a sore thumb. Markets reaching to liquidity or reaching to inefficiency with the purpose in mind to reprice and rebalance that inefficiency. That is what we use for directional bias. But the narrative that's required that would deliver that up move or down move hinges on time. So there's three factors here now. We're repricing for liquidity, repricing for inefficiency with the purpose of rebalancing. And all of that is delivered by a basis of time. We're not surprised, okay? We're not surprised when moves happen. We're not like, holy crow, look at that. Where did that come from? Who saw that coming, folks? Let me get on social media. Hey, did you just see what happened on the British pound? What just happened? I don't know. It's SICT. I don't know. I'm looking at ES. I ain't looking at pound. So why I am not, and my students are not surprised, is because we understand the time aspects intraday. We know that there are certain signatures that tend to repeat, and you hear me talking about them all the time, whether it's in tweets or in live streams, and it's macros. Macros are these little time windows when these subtle nuances come into price delivery, and the market will start running. Now, you have never paid that much attention to it because you were never told to look for it, which is the reason why it goes underneath everybody's radar. But now, with me telling you, this is what's going on, your eyes keyed up. Your reticular activating system is now dialed in on these specific times of the day. What times of the day are they? Well, I taught you that's 9:50 to 10:10. That's one. 10:50 to 11:10. That's another one. That 3:15 to 3:45 in the last hour trading. That's one of them. There's certain processes, little lists of orders, which is a macro. It starts to activate at these times. And looking at how the market is being delivered that particular session, that particular day, that particular week, we can anticipate a great deal of expected delivery and price where it's not guaranteed. Nothing's never really guaranteed, which is the reason why I promote and teach that you have to use a stop loss all the time. But I leave it to the viewer and my students to evaluate whether or not there's any efficacy to what it is I'm teaching. And with enough time, most people come around and say, well, yeah, this is no doubt now. It's obvious. It's here it is. And now you're seeing it with me calling every 1 minute candle, explaining why it should do this and why it should do that. If there is no algorithm, if there is no control mechanism that's delivering price, then there would be no way for me to consistently be able to do what I'm doing. It would be completely randomized. My results would be what? Falling short, 50-50, right? The things I tweet about, I'm taking your attention into a specific PD array. That PD array may be eventually an inversion level, the inversion of what would be normally expected, a bullish breaker. Okay, well, what happens if it trades below it? That bullish breaker may act as resistance now, which would fly in the face of what the introductory lessons on my YouTube channel state. But what's happening? There's a change in the state of delivery. Oh. See, those down close candles that you know about as my order block, it's not the down close candle itself. It's the flipping from its opening price. Once it crosses that, that's the change in the state of delivery. What's occurring there? The algorithm changes from sell side to buy side. And any retracement back down into that opening price is just simply like a return to resistance broken, now turn support. But it's not seen that way because it's not classic support and resistance. It's not supply and demand because we're not dealing with zones. I'm dealing with a very specific price level within a context that's not ambiguous, is very specific. And there are elements that are drawn together that make a model. And we'll talk about that as we go. But just like a down close candle, when it's got a fair value gap and the market's bullish and it trades down into it and touches that opening price of the down close candle, that's a bullish order block. That's a change in the state of delivery. Well, if you have a bullish breaker and the market trades down below it and it fails to get above it or support it, and it trades back up into it, what's happening right here? None of you are going to look at that because I didn't teach that on my YouTube channel. You're not going to see that as an entry. You're going to be waiting for it to do what? Go up above it, come back down and touch it and like a springboard, trampoline, send it higher. It can do that. But if you don't pick up on the subtle changes in order flow where now it's not likely to do that, what is it doing? It's returning back to that order block, which is a breaker. And it's a change in the state of delivery. Now, once it gets back to those inversion levels, because it could be a breaker, it could be a mitigation block, You've seen me use the fair value gap. And when I call out a fair value gap on Twitter, the trolls would say, "Oh, look at it, it failed," not even knowing what I'm doing. I'm drawing your attention to it because it's going to become what? Inversion. We want to see it trade through it and then act as resistance, or trade through it and act as support. When just simply understanding whatever I talked about as an introductory lesson on my YouTube channel or my core content lessons in paid mentorship, because that's all that was a language. People's out there making courses and, look at this, I'm teaching you order blocks and so you don't know what an order block is. You have no idea what it is. You're going to learn by me pointing to these specific things real time, whether it be in tweets or in the live streams. There's a process that you submit to that allows you to be comfortable, not anxious. We're not worrying about something. We're not worried about missing a move. We're not worried about any of that stuff. We're waiting for it to present itself. We're not reacting because we're already anticipating it. See, when you anticipate something, that means you have the foresight to know it's likely to occur. Let's go back to the live stream on Tuesday for a moment. That morning I told you, I said, listen, I'm gonna go in here today. I'm gonna talk about an entry. I'm gonna push the button because there's people out there that say that ICT would never get on the live streams. He's never gonna push a button. He's never gonna do that because he'll fail because he can't cherry pick. He's got 17 laptops. And my attention span is just this. Like, there's no way I could be looking at all these different monitors and keeping different, setups and stuff. And TradingView's one account. That's it. So I sat there and told you, I said, we're going to do one entry, one setup. And I want you to see what it's like to submit to one idea. But I'll tell you, there's other ones in here, but I won't take them. If you didn't really pick up on this, I want you to go watch the live stream on Tuesday. I did. It's not that long. It's like an hour long. You put it on twice the speed, and I'll get you right through it inside of 30 minutes. I promise it'll be short and sweet. But I want you to listen to how I build you up with your expectations going in. That we're going to absolutely see the 2022 model. It's absolutely happening, which is exactly what I taught you when I was teaching it last year. It happens every day. It happens every day. Now, can you go out and say, my harmonic crab is going to happen every day? My harmonic unicorn. It might not be there. You're not going to have your harmonic bats in your belfry every single trading day. But, and this is something that you really need to grasp. And this is why I listened to this young man that was on, I can't remember the company's name. It's going to sound like I just don't want to represent him, but the guy that's the farmer, and he's a prop fund trader or whatever. He was being interviewed by a guy from the company, and he said that they've done a lot of payouts with students from my fold and what they've learned from me. And he says it's really interesting to see how the students that come from our fold, the Lions, then that they have a strange sense of confidence that the other people that get payouts don't seem to have. And his words were, it just seems like we know and they know they got lucky. But you don't hear that from people that's trained with us. When you do it this way, we are absolutely confident. We know that we know. There's no ambiguity about whether or not we're going to see what we're waiting for. We know how to stalk, we know how to hunt, and we know how to take it down. And I was showing you that this Tuesday. I said, listen, there's going to be other opportunities in here I'm going to point out. Okay, I'm only interested in going short. I said, here's where it's going to run up here. It's going to go into the 28 level. That'll be 5 handles. I'm not interested in that. So there's one trade. I said, right now we're above this hold high where buy side is. This could be a turtle soup to trade down here. That's not what I'm going to take. I'm not interested in that. We're waiting for what? What did I say we were waiting for? We're waiting for displacement at the downside, then a fair value gap to form. I'm going to sell short the fair value gap that forms and write it down into the sell side liquidity. And I'm going to try to do it with 5 handles. And then I said, you know what? It's just not like me to just do 5 handles. I always got to over deliver. So let's just go 10 handles. And then I showed you that there was 2 fair value gaps there. And then out of the 2022 model, out of the rules, right out of the book of ICT in 2022, it says that if there's 2 fair value gaps, you have to allow for the market to trade up into the second one. So I was being a little bit more demanding on price action and being willing really to let it go without me if it didn't do it. But I wanted to wait and see if it trade up in that second fair value gap, the higher one. And I built the context around that bearish breaker. We can trade inside of the range of that breaker before it even really moves away from it. Once you understand the narrative, once you understand what it's likely to do, you can go in and do very, very refined entries. And I outlined that breaker. I outlined the fair value gap and the delay of trading view. I mean, because you can see me, I pushed the button and it didn't execute. It was a wait. And I even complained about it. I said, look, you saw me push the button. And then it was a delay with them filling me, which is fine. It's okay. But you're going to have that too sometimes. Your broker's going to give you a requote, maybe twice sometimes, and you won't get the fill you want. That's going to happen. It's going to happen in the real world too, not just in paper trading. It's going to happen. But does it change the overall understanding of what you're looking for in that setup? If it doesn't, then it is what it is. You have to manage it now. You have to trade your way through that. And that is a market truth that you're not always going to get your best fill. You're going to get slippage. Does it change anything? If it doesn't fundamentally change anything, you submit to it. You don't get all nervous and freak out thinking, oh no, this trade's going to be a loser. Look at all this. And you start obsessively, compulsively thinking about what didn't happen for you favorably with your entry, like I used to do as a 20-year-old. And then completely distract yourself from paying attention to what the price is doing and maybe giving you warning signs that you're no longer in a viable trade, but you still hold on to it and it stops you out. So you have to be careful with not making a mountain out of, a molehill. But I framed that breaker. I even explained that, it can go 1 tick above the breaker's high, which would be reasonable. And then I said it would go lower. And it was just beautiful. Beautiful. And it was just like I see 90% of the time. The things I talk about, I'm trying to show you that these things are repeating with a level of precision, consistency, and continuity that is outside the scope of what would be reasonable in this industry. And that should be encouraging. It should be very encouraging. And if it can be like that for me, and it can be like that for my students, then it can be like that for you too. But you have to do what? You have to show up every day and you have to go through the motions like everybody else that's making big money with this stuff. They didn't learn it right away. They floundered with it. They hemmed and hawed and thought, oh, well, I'm probably going to quit. Everybody feels like that once in a while. It's like exercising. You think you're going to get the 21-inch guns just because you started working out 3 weeks ago. But I'm drinking protein shakes. It takes time, man. And this is no different. It's actually it's way different. It's really harder because you're competing with your expectations that are many times unrealistic, which is the reason why I teach you to do very low-hanging fruit objectives. 5 handles is easy, folks. Easy. How many times have you sat with a live stream and said, okay, it's going to do this, it's going to be 5 handles, boom, it delivers it. Okay, it's going to go down here, boom, that's going to be 5 handles. 5 handles are all over the place. You could be making 20 handles a day in a market that ain't seeing sustained one-way runs of 20 handles. It's just back and forth. It takes time to get there. Are you willing to give yourself that permission to develop over time? Because sometimes you aren't. Some of you listening haven't really given yourself permission to take the time that's required for you uniquely finding your own model, Not trying to keep up with your friend on social media circle, the guy that put you into trading. You want to catch up to him, or your girlfriend that's been, starting the same time as you. She's understanding a little bit more, and you're trying to keep up with her. That's not how you're supposed to be doing this. If you're competing with someone else outside of yourself, you're doing it improperly. And that's a market truth. You can't do those things and grow, well, at a normal growth rate without having performance anxiety, regret, remorse because you can't keep up with someone else. I mean, you've seen me do many times, several instances of over 100 handles, 80 handles, 50 handles when the market's moving like that. But what am I teaching you? Am I saying go after those moves like that? No, I'm not saying that. I'm saying go in, look for 5 handles. Because every session, London, New York AM, lunchtime, New York PM session, all of them have an opportunity for you to go in there very, very easily and pull out 5 handles. Every single session, every single one of them. Now, is that me inviting you to go out there and do that? No. It just shows you that you have an open field of opportunity where you can just go out there and take it by force when you know what you're looking for, how to anticipate it, how to stalk your prey, and know when it's going to show up. When you're a hunter, I can't hunt. I just can't bring myself to do it. If I guess if I got hungry enough, I'd go out and kill something. Right? But hunters, they go out, they buy these trail cams, and they put it up and they leave it out there for a week or so, and then come back and download it and see if there's any deers coming around. And it tells them the time and the date and when they see them. So then they will know what they have an inside advantage that they need to put their tree stand up, hours before this thing usually comes through, and they just wait around for it. Okay. Well, that same thing happens when you see what it is I'm teaching. I've already set these trail cams up. They're windows in trading, the kill zones. I know the macros is going to happen. I know what the market's going to do. I know when the price is going to spool. I know what liquidity is going to reach for. And I'm not talking out of my ass because I'm proving it on Twitter live in tweets that can't be augmented or changed. I'm not deleting anything. And you see it in the live streams, live, right over the 1 minute candle. That should be building confidence in you. And I love seeing the students that are seeing at the end of the live streams are like, I felt amazing watching that. I felt so comfortable watching how price was moving. And you would say it was going to do this, and it did it. And then you would expect it to do that, and it did it. And then it delivered the next thing you said. That is not randomness. That's not randomness. And it should be very comforting that you're in good hands. You're with somebody that has the ability to transfer this information to you. Just look around. There's people making lots of money with it. Does that mean you're going to go out and make lots of money with it too? Probably not, because you're going to mess it up if you don't listen. We all do that. But you're growing in your understanding about it. And these elements of time, coupled with liquidity, coupled with inefficiencies and repricing to make them efficient, meaning a fair value gap gets repriced to. So it's no longer one candle holding all of that price action alone. It's now been fortified by a redelivery of opposing market delivery. So a down close candle, that's a fair value gap. We have an up candle trading up into that range. So now we have a repricing. Once it leaves that range and goes away from it, then it's rebalanced. What is it going to look for then? An opposing pool of liquidity or an opposing array that is inefficient that needs to be made efficient. How hard is that? That's not hard. It's very easy. It's not complicated at all. What makes it complicated is you want to know the daily bias every single day flawlessly. That's the hang up that most of my students have coming into me and asking me to teach them. If you could just teach me a real simple 5-minute video on how I can know the bias and I can do the rest. No, you'll lose money. You'll lose money. You'll do it. You'll go in there and you'll rush to get in or you'll wait for confirmation and it'll move too far and you'll try to use a stop loss that isn't reasonable. It's going to pull back in a normal retracement, stop you out, which would be a new buy signal, but you won't see that because you're now upset. And then it market runs away and you think, oh, this is crap. Nobody makes money with ICT concepts. When it's you rushing to do something that you don't know how to do. It's simple. But you don't want to see that. Just like I have students out there that are raising up pitchforks and torches. We're going to get you, ICT. Your shit don't work. Well, I got receipts that says otherwise, and I got people all around the world proving it does. And I'm doing live streams proving it does, and there it is. But you're going to be just like them if you don't listen to me. And I told them the same things I'm telling you right here in those long, drawn out lectures over live data, just like you watched me do today, and just like you watched me do on Tuesday. And if you can't learn under those teaching lectures like that, I promise you, listen, okay, listen. I want you to understand how I don't need your ass to watch me. I don't need your ad revenue. I don't need you to support me on Twitter. I don't need any of that stuff. I'm here for the people that want to learn. But if you don't see value in the things I'm doing, in the amount of time I'm pouring into you, this is not ad revenue generated here. I'm talking to you with no monetization. And this is where the real shit is. This is where the real lecturing, the real mentoring, this is where it's at. Because I've already talked about those live stream things that I'm pointing at. That's already been explained to you. Some of you just need to see, can he really do it? Yes, of course I can. My students would have outed me years ago. Every year I was saying, if I'm not calling these markets live right now, every day, behind my paywall, all my students come out here and say I'm a fraud, that I'm not calling it right. And it never happened. You know what I got? More people signing up. And they found out that it was just like that. And you're seeing just what I was doing with them. It's just like this. It's been like this for years. It didn't just start working. But some of you think that this now just started working or it's going to stop working because I have a lot of students. The algorithms, they're going to change the algorithm, Michael. Here's the market truth. It ain't fucking changing. It's not. Oh, they're going to change the tier 1, tier 2. It's not changing shit. It's not going to change anything. That's not changing anything. Trust me, okay? This stops working when you cannot trade, period. When they take trading away from us, sometime in the long distance future or maybe in the near future, I don't know. But there will be a time some nutcase will come out there and say, we're taking this from you. We're making it illegal for you to do it. It sounds far-fetched, but man, listen, the last 3 years, anything can happen now. They're saying ET's real. I was telling my private mentorship group this week for comedy relief. I said the Pentagon came out and said that there's a alien mothership in our solar system sending probes to our planet. This is our Pentagon chief UFO person. It's they've made the person that's in charge of all that crap. That's the bullshit they're saying. That's science fiction stuff. Remember I told you it was coming? Well, here we are. We're in it. Yeah. Man, I could go on all kinds of rabbit trails and go off on a rant here, but I'm going to try to dial it back in. You're going to see by submitting and listening to these conversations, because I want you to look at me not as your educator. I want you to look at me like your best friend in the marketplace. I'm the voice of reason for you. I'm the person that's trying to keep you on the right track, not over leverage, not risk, not gamble. Look for things that make sense and stay on the well-beaten track, the trail that I've forged for you. I've walked this path a lot. I know it. I can walk it blindfolded. You haven't. You don't know where the thorn bushes are. You don't know where that little root that sticks up in the ground that nobody else that knows about it would trip over, but I know where it's at. You don't know where the pitfalls are. You don't know where the poison ivy is. You don't know any of that stuff. So I'm lending you my experience through Twitter, calling out specific levels and watching what it should reach for. And I'm giving you those opportunities to have that epiphany, that moment of astonishment where you're like, oh man, I see this. This keeps happening. There's something to this. It can't be random, right? It's not. I've been telling you all that it's not random. But some of you have to have that experience before you ever put any work into it. Like, I don't have to do these live streams. I enjoy it. I don't have to do all this talking on Twitter and have my wife look at me all day long, like, why are you on the phone still? It's Twitter, honey. Look, see, here's what I'm doing. You talk to them too much. They're probably tired of hearing from you. I'm sure some of them are, but other people figure I'm not tweeting enough. So, it is what it is. I'm doing it because I have to do it. You can turn the notification off if you don't want to hear from me. But if you can't find the value in me explaining it in detail, like the most recent student of mine, Alex, he made a very good point. If I didn't know what I was talking about, I wouldn't have the volume of work that I have on YouTube. Like, and I'm not even done. I have shit. I have so much I could still teach on. It's ridiculous. But you don't constantly have to be learning new stuff to be profitable, which is the point of this discussion tonight. Unfolding truths. You don't need much, but you need to know what it is that you're looking for. For instance, the opening range. That first 30 minutes of trading the ES. ICT, why don't you talk about Forex? I don't want to talk about Forex right now. My attention's on futures. The things I'm teaching you work in Forex. So just take the information and apply it to Forex. Just like you all that trade crypto. You've heard me say I'm not interested in crypto. And the ones that are very respectful said, okay, well, I'm not going to bother the man about it no more. I'm going to trade it. But, he's not going to do it. So I can't twist his arm. And he's an old dog, doesn't want to learn new tricks. And there it is. And you just filter it out. Well, I'm asking you, if you're a Forex trader, filter out the fact that I'm not talking about Forex. I'm still talking about Forex. I'm still telling you, from a macro perspective, where the dollar's going to go, where's the pound going to go, and the euro dollar's going. But I don't need to do it every single day, because where I'm giving you analysis, it takes time for those big moves to pan out. That's swing trading models. So I'm giving you that approach where I don't have to babysit it every single day. And also by understanding that if I'm using market analysis concepts from a macro perspective, risk on, risk off, if ES is dropping, or I'm expecting to be bearish, what do you think I'm expecting for the dollar index? It's going to go higher. Dave, if you're listening, you want to have the dollar index in your analysis, even when you're trading the ES, because market symmetry is perfect when it's like this. Dollar up, ES down, foreign currencies down. All lower lows and higher highs are confirmed across the board. That's market symmetry. As soon as you start seeing ES higher, Forex higher, and dollar not going lower, but consolidating, that means that you have a condition that's manipulation. That means that ES and or Forex can go up higher high, and then the real move starts happening. So it's important to not just throw out the dollar index because you're watching two markets. It's important to understand how market symmetry aids the trader's perspective and analysis technique, because there's a different degree of market delivery, whether it be high resistance. High resistance would be in conditions like where the dollar index is being held in consolidation. And you can still see Forex pairs going up, ES going up, but dollar fail to make the lower low. That means you have to trade that differently. What kind of environment is that? That's high resistance. You're going to have to go through something before you get your targets met. Versus a symmetrical market. See, these are the things you're supposed to be writing down. This is $1 million making stuff here, folks, okay? I mean, I ain't going to bullshit you. This is the stuff that makes your trading superior to everybody else. But you don't realize it because you're not in these discussions taking notes and going into your chart saying, oh, wow. Man, he ain't lying. It's right there. Right. Yes. I'm leaving it to you to go into those price moves and see it. I'm not going to do all that work for you. I'm not convincing myself. I know this stuff. You need to be convinced of it. And it doesn't happen by me doing a video where I do all the work for you or condense it down to cliff notes like everybody else is asking for people. Hey, look, when you do his Twitter space on your YouTube channel, can you give me the transcript and the condensed version and the notes that you took during that? Because I really don't want to listen to it. He talks too much. He's full of shit. He does all these extra stuff. And I ain't got time for that. I got things to do. Right. You got things to do losing money. Okay. You got a real fast track on losing money. And then you're going to be down 3 months later saying ICT concepts don't work. Let me go over here and trade this Yahoo's stuff. You're the problem. I'm not. You are. Because I'm laying it out here. All of it, it's happening for free. And I'm proving it live. But you don't want to listen because you think your time's too valuable right now when this is an investment in yourself. I feel like you're worth it. Listen, man, I don't need to do this stuff. Like, I don't need to do this. I'm not priming you for another mentorship run where I can get more money out of you. I'm doing this because I love it. This is my life. This is what I've been doing my entire life. I love this. I love teaching people how to do it. I love transforming people's lives and their mindset about who they are as a person and what they can accomplish. And if I believe that you're worth investing the time and energy in, why the fuck aren't you? Why don't you think that about yourself? No, I ain't got time for that. Let me give me the commercial grade 5-minute trainer version of this stuff. And then you wonder why you got dollar menu results. It's not because the concepts don't work. It's because you're half-assing it. You're using a half-ass mentor, watered down Cliff Notes version of what I'm pouring out, walking you through the logic, why it should do this and why it shouldn't do that. There's reasons for these things to be even talked about. And while you might not understand it, I don't like all these other PD arrays. Well, in the beginning, you got to know all of them. Doesn't mean you're going to use all of them, going into your career, but you need to understand all of them until you settle in on the one you like. And what does that mean? What I did on Tuesday. I told you that we were going to rally up and take that 28 level out, and that's 5 handles. I don't want to buy it. It goes against what I wanted to do. Oh, okay. I told you we were above the old high. We were in buy side. It's going to sell off there. I don't want to take that as a short. I'm going to wait for the displacement. Okay. Well, there's another trade right there. And then I told you we were waiting for the fair value gap. My mind was settled on taking that trade. That's what it's like for you. You'll see all these PD arrays. You're not looking at and being distracted. Oh, I don't like breakers, but look at that breaker right there. And the whole time it's forming, institutional order flow entry drill, which might be your entry technique. That's your multiplier. That's your model. You're aware of the breaker, much like I used on Tuesday. That wasn't the entry criteria, but it was being utilized to show you how far it can retrace and not take out that high it made. Do you understand that? Can you draw the importance of knowing the PD arrays for that purpose alone? Now, the breaker in itself, if you weren't taught the fair value gap, you would have been using that breaker as an entry only after it moved away from it and then bumped the bottom of it. That's far less of a premium than where I entered it with the fair value gap, the second higher one. See the difference there? Now, some of you might feel like, I feel comfortable trading the breaker when it broke away from it and came back up and retested it. I'm used to seeing it. That's what I want to do because you're comfortable. Well, guess what? Don't let me change or anyone else talk you out of it. That's your model. Bloom where you're planted. But you can't just go out there and say, yeah, I don't know what I'm doing. I don't know this model or any model really, but it's just too much stuff. I'm not going to do it. But then you're lazy. that's the bottom line. You're lazy. And I don't want to see people adding my handle on Twitter talking shit like that. So I mute them. I'm not trying to block them so they can't see anything I teach, but I just don't want to see that shit. So I hit mute and there it is. You can talk out your ass all you want, but you're doing it with a half-ass approach. And you're going to be that same person months down the road that will not find the results that other students of mine are doing, and they're killing it. And you'll walk away thinking that, this isn't all that. Wonderful. Move on down the road. Like, I'm not here for you to worship me. I'm here to invest my time and energy into you, and I can leave social media in November and not have to worry about it because I know I've done more than enough. But that opening range, that first 30 minutes, how do we open in that? Are we opening with a premium? That means, are we opening higher than where we closed in the regular session hours the day before? Or are we opening lower? If we're opening higher, it's a premium. Not in the sense that I'm teaching premium in discount for the PDRA matrix. It just means that we're opening with a gap higher, and that's a premium. Meaning that it's too expensive right now, and we have to see, does it have to finish a higher time frame price run, which is what we saw today, where the market opened at a premium, it rallied up and traded to that 40.39 level, the 5-minute fair value gap, the SUBI, which ended up being the high of the day. Market traded lower and eventually went right into that opening range gap. So it went from opening in a premium at 9:30, trading higher, only to reach a higher time frame premium array and then sell off. Which brings in the idea of day of week and time of day. Today's Thursday, and we've seen it rally up this week. And Thursday tends to, not all the time, but tends to create the opposite end of the weekly range. So we can anticipate some likelihood of the market topping out, and always going in anticipating some reason for it to do what? Trade softer, go lower. We saw that today. It rallied higher, and then ultimately gave up the ghost and went lower than it did yesterday after FOMC. Trading down into some random level, new week opening gap. Failed to get down to the new week opening gap low by a tick or two. But that's okay. That's close enough, right? Significant drop in the afternoon. When we started the live stream, I was outlining where I thought the market was going to go, what it shouldn't do, why it should gravitate lower. And I walked you through every single candle. This is what it should do. We don't want to see this, but it could spike up here, and that would be great because that would be knocking out trailed buy stops, and then it's probably going to have a really sudden drop. It didn't do that. It went just to the high of that opening range gap. Remember that orange or tan shaded rectangle I had in the live stream? It went right back up to that and then started selling off, and then created what? Every up close candle, we're expecting it to do what? Repel price, because it's what? Bear shorter block. Every consequent encroachment of a wick high, treat that as what? A premium array. Go up there, does it repel price? Yes, it does. Volume imbalances. Is it going up there, repelling price? Yes. Can it trade through a volume imbalance? Come back down below and act as resistance? Yes. All this movement and price action was being explained to you. What's the next discount array? That fair value gap at 85. Traded down into it. Then that tells you what? It's going to reach for the low of that opening range gap low. And it traded down into that. And I said, now if it goes there, it's going to reach into the new week opening gap high. And it did that. And I said, okay, well, watch the consequent encroachment. Every time that I point to something, your job is to observe and pull in that experience. Do you feel anxious? Do you doubt that it's going to do it? What are you feeling? In the beginning, you want to have all your critical thoughts written out. And then over time, while you're building your model and you're back testing, you're not recording anxiety or stress driven annotations. You're recording the perspective that you knew it was going to happen. And you're tricking your brain with positive self-talk, which cancels out all of the necessary evils that come in the beginning for a trader for them to want to quit. You're going to cancel that because you're feeding yourself positive self-talk. The move, you may not have seen it coming and you're looking at it in hindsight, but you're recording it in your journal like you did. And your subconscious retains that. And because you're seeing something that repeats because of the way it forms, fair value gaps and delivery to old lows and old highs and imbalances, when you're watching it live with me, and I've saw some people today, they were commenting, and it's not just today, I've seen it several times in the past when I was doing the live streams, that you're anticipating before I say what it is I'm saying. You're already seeing it. And you're saying that it feels good that you're seeing it before I say it. That's exactly what you want to experience. In the beginning, you may not feel like that. And that's okay. That's why I'm doing the live streams. I want to teach you. I want to teach you by example with my ability to be able to do it real time with you. I'm comfortable doing it. I'm confident. I'm comfortable. I'm good at it. You're in good hands. I'm doing it enough so that way you can go in and then do it on the days I'm not doing it and practice. Record what your observations are and not be emotionally strung out because it doesn't pan out like you want. Because you're going to have that in days where you're going to try to put a trade on and it's not going to move in your favor. And you're going to wrestle with that. And some of you are going to get angry. Some of you are going to be resentful and you're going to do something stupid. You're going to over leverage. You're going to trade too much and you're going to hurt your account or blow it, lose your funded account. And I'm trying to teach you how not to do those things, how to focus on times when you know it's going to be hard when I say it's going to be a high resistance liquidity run. Doesn't mean it can't move. It just means that it's going to be very, it's almost like the price is being argumentative. Yeah, it's going to go there, but it's going to be begrudgingly about it. I don't want to go there, bub. Okay. I don't want to go to that buy side right when you want it, I don't want to do it then. I'll do it on my own time. That's what it feels like when I try to personify what price action is doing. Like if I'm arguing internally with price, like, why aren't you doing what I wanted to do? Why aren't you doing why aren't you submitting to what I know you should be doing right now? And I view it as it's arguing with me, saying, listen, you want me to do it. So therefore I'm not going to do it. Like my wife, can you do this? Look, I'll do it when I'm ready to do it. Well, it is then, right? It's done. Submit to the process, right? So with price in a low resistance liquidity, it's very, it's almost like it wants to do it before you ask it. It's telegraphing. I'm going here. Everybody's stop is up here. Okay. And I'm going to go up there for you. And I'm going to do it really fast because I don't want you to grow impatient, ICT. It's going to be so quick for you. All you have to do is to sit back and let me reach your limit order. I promise you, big guy, I'm going to take care of you. I'm going to take it right home. Boom, baby. I'm going to give it right to you. And that's what it feels like. It feels like Christmas morning. And that's what you're trained to see as my student. Because there's a totally different experience trading those types of markets, those days, those sessions, where it just feels like, what the hell just happened? That was so easy. And here's the problem with it. This is the part where you write this down, okay? When you have these windfall victories in these low resistance liquidity run conditions, when you have that win, it's like, man, that took like no effort at all. It was very fast. I got to go in there and do it again. That's the trap. That is the trap. When you have these easy windfall days, these goobers out there that like the sock puppet and troll people because they can't get attention, they'll tell you, you got to push your edge and don't take partials. You got to go in there and do it again and then lose what you made, if not all of it, some of it, which is stupid. You're throwing good money after bad. The point is the trade in these environments, get your easy wins and go home happy about it. We're not in this industry to do lots of trading. I took 15 freaking trades today, and they were 12 wins out of 15, baby. Look at me. I'm an ace. Really? I went in there and traded for 20 minutes, made your whole monthly salary, and I went out and started watching movies and playing with my kids in the park. And you're out here sweating, trying to get 15 trades and didn't even do half what I did. See a difference there? Everybody's perspective is skewed. Mine is I want to go in when it makes the most sense to do it. I want to be in there, easy, in and out, bang, it's done. I want to be in the trades that run, not just hang around. I'll get there when I get there, ICT. Just hold your britches. I don't like that. I like shit my way. They name streets after me, one way. And I want my way. Okay. Some of you come to me, you want to have it your way mentorship, like it's Burger King here. It ain't Burger King. We're not flipping fucking burgers. Okay. We're flipping accounts. Okay. We're taking things to whole new levels here. And we want to go in when there's a jetpack behind our trade and just boom, it's gone. Now we're talking hyperspace. We're not wasting time wondering when it's going to move. We know when it's going to move. We know how it's going to move. And it's going to be quick about it. Expedient delivery. That's what you're being trained to look for. You can't appreciate it or identify it until you see these types of conditions. You won't understand it. You won't see the difference. The characteristics are different. For instance, look at how it traded this morning going up. It was a little lethargic for a little bit, and then boom, 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 ran up into that 40 level. Then it had a little bit of give and take back and forth as it was dropping down. And then once it got below that 40-10 level, that new week opening gap, and then traded back up into the daily fair value gap SIBI high, that was it. Then we entered into what? Low resistance liquidity run. Where's it going to reach for? Filling in that opening range gap. The difference between where we opened in the morning at 9:30 and where we closed in the regular session hours yesterday. And I walked you through it live in the afternoon. You can't appreciate it until you see both sides of it. And when I'm prompting you, I'll say, you want to log how you feel right now. Some of you think that that means go into your journal and bitch to yourself about how it's hard. No, you need to be saying prices being very fickle. It's being very, well, demanding of my patience. It's not delivering as fast as I would like to see it do. You see how that sounds versus this market sucks. This is Chop City. This is garbage. This is trash market conditions, blah, blah, blah. How's that useful? It emotionalizes that experience where now you're viewing it subconsciously because you put that in your journal. Oh, this is trash. This is garbage trading conditions. So now is that going to be a market environment that you're going to feel comfortable with? If you see a setup, you might see the setup, you might want to take the setup, but subconsciously, you don't realize it, but it's manifesting underneath the surface in your psychology of how you're interpreting how that price is going to likely deliver. You're going to tap into that negative recording in your journal that you spiced up with negative reinforcements, trash market conditions, which means what? That's probably going to be scary. So subconsciously, you see the setup, yeah, but subconsciously you're thinking, man, I'm probably going to lose on this. This is probably really low probability, but you're going to try to wrestle with it, which means what now? You're in a trade or about to take a trade, and you're in a divided mind. You see a signal, you want to take the trade, but you've poisoned, tainted your subconscious. So now you have fear. You've invited, you engineered fear in your next trade because you recorded something in your journal or you posted something on social media You had a conversation with somebody else that's trading, and you said that you suck as a trader. You're not able to get this stuff to work, and you can't ever get it, and it's always failing on you. Blah blah blah. You're reinforcing subconsciously that you're a loser. What do you think is going to happen when you start pushing the button? That's going to manifest itself in your actions. Just look at YouTubers out there that are toxic. They're doing it to themselves, trying to make themselves look better than me, and they're blowing their ass out right in front of everything and killing their entire brand. And all I'm doing is sitting back watching them do it. They're doing it to themselves, just like you're going to do it to yourself if you do these things. You have to coach yourself. You have to cheerlead yourself. You have to pamper yourself in that journal. That journal is your love letter to yourself. That's the encouragement. That's the letter to your future self. These are the things that I have thought about for you. I'm planning all these things for you, your future self. You're writing all that to that person that you're developing into. But are you feeding that person positivity? Or are you choking it and strangling it with negativity? It's real important. And you might think that, oh, it's not that big of a deal. Journaling's for, for the weak ones. I don't need a journal. I just go in here and I take my trades. I got a model, I got an edge, and I got time to mess around with that journal stuff. I'm going to tell you that's a person that ain't making money consistently. I'm going to tell you that's a person that's going to be an emotional basket case while they're trading. They'll be highly emotional. Like if you listen to me talking, like there's no difference between that and me reading a book about fishing. And I'm not a fisher. Like it'd be the same thing. It's this guy's putting me to sleep, man. What the hell's going on? That's what it's like. When you know what you're doing, that's what it's like. And you want it to be that way. You don't want neon lights and rave shit and music pumping around. And now it's emotional stimuli. No, 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 no. When you're learning, it needs to be boring. Now, when you get good, you know your model. You want to play some, blasting music that gets you all fired up. The ride of the Valkyries, if that's your thing, right? Whatever it is that gets your juices flowing, when you know which you're looking for and the model's there in the charts and you know you're in the right day and everything's lined up. Sure. Yeah, man. Like my speakers are blaring. Like it's my upstairs is pulsating. I have a lot of sound coming out of but hey, that's my thing. But I'm not telling you as a developing student to do that while you're studying. It's counterproductive. You want to bring yourself to a level of anticipation, knowing that these things are likely to form, when they're likely to form, and how they're likely to form in a boring condition. Because you're not presenting any invitation for emotional stimuli, which will be distracting in your early development. You want to see every boring detail. This is what this chart should be doing. This is what this candle should do. It should not do these things. It should be allowed to do that, but not do this. Okay. And you're learning all that. And I can't write a book. Okay. I can't write a book that's going to say these things in words and it make any sense to you. That's why when I mentor, I was doing live sessions and I was reading price to them, just like you're watching me. And I'm sure there was people today watching me do that. And they said, this guy didn't push a button. He didn't enter a trade. He's talking all this stuff and the market moved and he didn't do anything. I was teaching. I was teaching people how to submit themselves to price delivery. And I also talked about how when you're in a move, I guarantee you these people that are very critical, they're probably getting in there and getting 3 handles or getting 6 pips in a Forex move, panicking the entire time, not realizing all the other move that's still in the price action because they're emotional. They're making everything a competition with themselves and everyone else. And everybody that's highly competitive, they're shitting themselves on social media. Just look around. None of them can carry themselves forward consistently. They're all wrecking themselves because they're trying to do something this industry is not meant to do. Compete. That's not what this is for. Look at that Robbins Cup. People are up on the leaderboard. They're falling off the leaderboard, getting real high and then falling off. It's a wonderful psychological experiment to watch how these people really push the envelope. And some of them are clearly gambling. And I don't want you to have that mentality. But what do you think would happen? Let's just play devil's advocate for a moment, okay? What do you think would happen if you got that position in your learning, that plateau of now you're bored. You know what it's going to do. You know how it's going to deliver. You just got to wait around for it to happen. And then when it presents itself, you push the button and it does what you thought it was going to do. And the results were expected and it was delivered as such. What do you think happens when you start applying gaming theory and money management to something like that? When you're no longer emotionally stimulated by the result, but you're now pushing the envelope with high precision, high strike rate, high accuracy, and now you have optimal F applied to your risk management. You start seeing extrapolated increases in your equity, and you still don't have the emotions. You don't have the fear. You don't have any of that stuff. And when you place that against something other than what's normal in this industry, it rips it to shreds. Nothing comes close to that. It's breakneck velocity in terms of the equity increases. And contests are not even a contest. It's a clinic. Here's what you'll never be like. Here's what you'll never be able to obtain doing the Mickey Mouse shit you use. But you can't jump into that. You can't just jump into that league. There's a lot of things you have to do to prepare yourself. You have to completely desensitize yourself to the ebb and flow of your equity going up and down in a trade. And I talked about that today when we were live streaming. The reason why I've talked to you in these live streams the way I do and in these Twitter spaces, because I want you to remember these discussions. Because when you're in a live trade, and some of you probably have never been in a really profitable winning live trade with real money. When it happens, and if you're not sitting with a trade that has a limit order where you know where it's going to go, you got in, you don't know what it's going to do, you're just giving it a chance to start moving around, and it explodes in your favor out of blind luck. I say that facetiously, obviously, because if you're using what I'm teaching, it won't be blind luck. But it'll explode in your favor. And then you have this problem. It's running. Profits building constantly. And you're looking at it like a deer in headlights. You can't move. You're paralyzed and you're watching the candle expand bigger and bigger and bigger, and the profits growing faster and faster and faster. And you don't want to touch the stop loss, but you don't want to close the trade. But you're thinking, I should close the trade because I'm making so much money. What happens if it reverses? And it still keeps climbing. It still keeps building up. And you're all hopped up. And it feels like panic. That's one of the hardest positions to be in as a trader that's new. Because everything you do is going to be wrong. If you get out right now and it rips even more, you're wrong. If you don't get out and it retraces or reverses, you're wrong. If you stay in that position with no limit target placed and you don't trail your stop loss to lock in something, you're wrong. And that's what's happening at 100 mile an hour in your mind. All these things are zooming through and you can't focus on any one thing. All of a sudden you have attention deficit disorder. You didn't have it before, but you have it now, buddy. And it's a weird feeling when you encounter that. It's like, what the hell do I do? What do I do? And if your spouse is in the room, they start talking to you. Shut up! Don't talk to me right now. Look, don't you understand how hard this is? I told you, I got to be focusing. Now, minutes ago, you're reading the fucking comic books, eating potato chips, clipping your fucking toenails. But now, because you're in this position where everything's flying at light speed, you're not losing money, you're making money. You have no idea what to do with it. And here's your spouse just saying hello to you, and you're tearing their fucking face off. because that's one more thing that's competing for your attention because you didn't do what you're supposed to do. Have your model outlined. Where's your profit targets? Where's your partials? You have to be prepared for those types of things. And it's going to happen. You're going to just get in there one day and just see, this looks like it might move. Let me put it in here and not put your limit order in, not put a partial in. Let's just see what happens. And boom, NASA, rocket takes off. Boom, it's off to the races. And then when it happens, you don't know what you're not supposed to, you won't know what you're supposed to be doing because it'll be moving too fast. And I guarantee you, whatever you do that moment, you're going to regret it later on. I wish I would have got out sooner. Wish I would have held on to it longer. I wish I would have moved my stop loss up more. I wish I just would have just sat still. And you're going to be flipping through all those decisions so fast, so fast. And you're going to be panicked. And I'm holding these discussions with you because I want you to remember these things. When you're watching price, using the things I'm teaching, you're not going to be surprised. You're not going to have these, where'd that come from? Why did it happen? Why did that happen? Let me go on Twitter, ask everybody else, dude, what just happened? You don't ever hear me saying that. My students don't ever hear me saying that. In any of the mentoring I've ever done over live streaming when I was mentoring behind the paywall, they never were like, whoa, where? Nope. We were anticipating everything. That's a different mindset. That's the truth. When you're here with us, we're training you to be a soldier that's war hardened. We know what we're walking into. We know bodies are going to be stacking up, and we're doing the stacking. We know that someone's losing their ass, and it's on the other side of our trade. We know our setup is coming, what time of the day it's coming. We know how it's going to form. We're waiting to ambush it. We know how to stalk our prey. We are not ambushed. We are not taken by surprise. We're not caught in a snare. We know exactly where we're placing our next step. We know the terrain. We've been here before. It's well mapped out. That's confidence. And to someone that's new, that's never been around us before, it sounds like fucking arrogance. And guess what? If you want to call it arrogance, fine, I'll own that. It's just me being around the block enough times to know I know my way around. And my students do too. It doesn't make us pieces of shit. It doesn't make us bad people. It just means that we know our shit. We know what we're doing. And these funded accounts and these companies, they're finding out. They're finding out we are built differently here. This is the Monster Lab. Okay. This is Monsters Incorporated. You come in here, you spend enough time, you're coming out a savage. Claws, fangs, everything. And you're going for your pound of flesh. And damn it, you're going home with that pound of flesh. When you have these opportunities to sit down and watch live price action with me, I want you to feel what it was like before you had these experiences where you were looking at the price action and just felt like, what am I supposed to do with all this? I'm tickled, honestly. When I read comments after the live stream, it's like, dude, what the hell? Like, it did everything you said it was going to do. Right. Now, I don't feel that way, but I'm amused when I see new students or people that's never spent time with us. Their reaction to that, I love that. I take the Twitters or tweets rather, and I show my sons, I say, look at this. This is someone now. Right now, I have my hooks in them. They're never, ever, ever going to forget this. In that moment, they're going to hold on to that, and they're going to want to do it themselves. They're going to do whatever it is. They learn how to do that themselves because they see it as a superpower, and it is. We're fucking mutants here, man. We're not like the average traders. We look at things with a precision perspective, discipline. We know what we're waiting for. We're not distracted. We're not taken by surprise. We're not looking at stupid shit that has nothing to do with what makes price go up and down. We're not worrying about fundamentals because fundamentally everything's in the technicals. Period. Like, what else do you want? What else do you need? Think about it. When you first started trading or got interested in trading, everything that you put your hands on, you know that the stuff that you were looking at just didn't make any damn sense. Like, yeah, I see what you're saying with these lines and stuff, doing this and doing that, but how do you know it's going to go there? Well, we really don't know. You just got to, eat it if it's wrong. No, 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 no. I know what I'm looking to eat. And it's fucking filet mignon. I'm pulling it off of somebody's ass in this market. They're going to lose to me. I know that going in every day. I know how to find that next victim in the marketplace. I know that. And you're being trained to do that too. And when you see everything else next to what it is that we do, nothing compares to it. It gives you confidence. It gives you clarity. You know what you're looking for. Think about it. You know exactly what you're looking for. It's going to run up to that liquidity, or it's going to run up into what? An inefficiency. How do you know if it's going to go to buy side or an inefficiency, Michael? How do you do that? Like, how do you know that? Well, has it ran up above buy side recently and then broke down, but has yet to take out sell side into a discount? Then it's probably going to go up into an inefficiency, a premium, and not run that high. It's already ran the stops. That's how I trust it. They've already went into the liquidity. Now they're just taking it into a premium to rebalance an inefficiency and then send it to the sell side and then reverse the other way if you're bullish. It's going down for inefficiency or it's going down for sell side. It's going up for inefficiency or it's going up for buy side. If it ain't doing that, it's consolidation. Think about it, folks. You got three choices: up, down, or sideways. If it's sideways, well, the calendar is going to tell you when that's going to happen. When do we expect consolidations? I taught you that. So if it's not around those times, then we anticipate expansion. Which side of the market are we going to expand on? Which side is likely to be traded to because it's been taken into sell side or buy side? The market's going to move to the opposite range. Why? Because smart money's going to want to do offset distribution. If they're short because they've taken buy side, it's going to go down to a discount, to inefficiency or sell side. Reverse it. See, it sounds complicated because you haven't been spending enough time with us. That's all. You haven't been watching price action. You haven't been seeing me outline it real time, telling you what it's going to do, why it's going to do it, what it isn't going to do, when it's supposed to do it. When you spend time in that environment, live over real time data with me, it's easily to convince you there. But you're still going to, at the end of the day, walk away from the live stream thinking, wow, that was amazing sorcery. That was a magic trick. He's doing something. Nobody can do this. And then you start thinking about how you can't do that yet. You're impressed. You don't know quite how I did it, but you go right back to thinking, let me turn it against myself. Can I do that right now? Which is unrealistic. But then you start feeling bad, like, this is really complicated. I want to see that in my own trading. I want to be able to do what Michael and his students are doing, but I can't do it right now. But I've watched 6 videos. I've been watching these videos. I've binge watched for the last 3 weeks. And I've put some things down on a notepad. I don't know where the notepad really is, and I spilled coffee on it. And what do you expect from me? Organization? Yes. Diligence, consistently showing up and taking it like a business. If you're just going to be willy-nilly with it, then that's what you're going to get out of it. You're going to get what you put into this. If you treat it like you're learning the highest form of financial warfare, you're going to handle yourself differently. If you're thinking this is like the lottery and it's scratch offs, well, come on. Of course, you're going to get Instagram results. Time of day and the signatures in the AM session, in the AM session run, they're going to be different than that of the PM session. And the benefit of knowing what that opening range gap is, if there is one, if we don't fill the gap in the morning session, we're going to expand till we get to a higher time frame PD array. Once we hit that, typically in the lunch hour, then during the lunch hour, we have some measure of retracement to morning session stops. Now, it can be exaggerated past that if we have not filled in that opening range gap, which is what we saw today. What do you think would happen if we saw this morning open, trade down, close in that opening range gap, then rally up going into the lunch hour? Any retracement lower on sell side would be what? Just to use to go higher in the afternoon, because the unfinished business of that opening range gap had already been taken care of in the morning session. Oh, it sounds like narrative. Yes. Things are expected. If they don't deliver, that means something. It tells us how we are to anticipate the next session. The morning session after FOMC or the morning session after a large range day, we are willing to simply let it do what it wants to do. We're using it for intel. We're out there collecting intel. We're not engaging. We're in a clandestine mission where we're out there just observing. How many victims are we going to stack up in the PM session? Where are we going to stack the bodies? That's where the liquidity is, the sell side. The new week opening gaps below the marketplace. The discount fair value gaps. We're mapping out all the terrain, where the sentries are, where the guards are, where's the strongholds. And then when the time comes and we get into that 2 o'clock hour, we release the hounds of hell, and it's war. And then you just watch price unfold like you've outlined it, which is what you watched me do today. It's amazing when you finally get to the point that you can do these things yourself. But all of the interviews I'm doing, and I have lots more of them. Got another one I'm recording tomorrow, but it probably won't be up until Monday. Why not? Why not, ICT? I want to space them out a little bit. It sounds like I'm filling my channel with just that. I got to put some teaching videos in between them. But when you have this epiphany, this moment of clarity where you know what it is that I'm training you to observe. When you finally get to that point where it makes perfect sense and you know exactly what you're looking for in price action without me having to say so, I cannot find words to fully articulate the level of fucking power and confidence that it gives you. And I'm sorry, I know some of you like, oh, the language. Listen, man, ma'am. We're talking about life-changing shit here. You can play Sunday school once you learn how to do it. You want to carry yourself differently? Sometimes I can't carry myself 100% stable. I go off the rails and I'm fighting very, very hard to stay on them right now. But when I feel what it felt like for me, and I know it's going to have the same impact on you, probably even worse, not worse in a bad way, but more impactful because you didn't go through 6 years of it. Some of you are just coming here, and in this a short span of time, you're already learning things that you were not aware that was even possible. I guarantee you, if I did a poll and you were being honest, not to try to fluff me out, because I don't want any of you doing that, but if I was to ask, how many of you are astonished to see that it is possible for someone to be able to call every minor fluctuation in the marketplace with that level of degree of precision? It was unfathomable in the beginning. Before you found me and anything like the things I'm teaching, you didn't think that was possible. I know I didn't. I just felt that there was people out there that would get more luckier than I was getting luckier on the few winning trades I had as a new student in the 20s, or not when I was in my 20s rather. And it's weird when you think about all of the things that you wrestle with in the beginning. Will I be able to do this? How long will it take me? Everybody wants to ask the person that's teaching them, how long do you think it's going to take before I start making money? Well, if that's the first question you're worrying about, it's going to be a lot longer than you want it to be because you're making it about the money. When if you just simply say, I want to get good at reading price action and I want to be desensitized to where I believe it's going to go and I'm submitting to whatever it does, that's a person that's going to make a lot of fucking money. That's a person that's going to be so consistent and they're not going to be swayed by any little fluctuation in the marketplace that might scare everyone else. I mentioned it today live. I said, look at this big green candle here. Some of you are like, oh, I'm getting nervous. It's going to reverse. No, it's going to go lower. It's going to go lower. It did. And that's what it's like when you have experience. You want to see these up close candles when the market's going lower because you want to see price repel away from it. That's a bearish order block. You want to see the middle of that up close candle hold price down. That's the mean threshold. And when you start seeing it go up into that level and just fail to go any higher, it hits like this invisible force field where it will not let it go past it. Iron Dome, baby. Nothing gets through this. It stops right here. When you see that, when you're watching that in price action, that's immediate feedback that you're on side. That means you're right. That means you're right in your direction. So stay with the idea. But if you start seeing premium arrays when you're bearish and 3 of them fail, bearish order block, mean threshold breaks. It trades above a short-term high where buy side is, and then goes through a fair value gap above that. Well, you probably reversed and you missed it. So now you got to make the decision. Do you abort it right there, or do you wait for a small little retracement in your favor and get out? That's experience. In the beginning, as soon as you see 3 fail, kill it, abort it. Don't even waste any time. I walked you through how the dollar index went up into 3 premium arrays I outlined. I talked about it before it happened. So I was taking your attention there. I told you, go into your own chart. And I felt sorry for some of you because I know you're new. And I went into the chart and showed you where that was. But I also outlined how we were going lower, lower, and then another low in ES, but almost getting to that new week opening gap low. At the same time, it went into 3 premium arrays on the dollar index. Time of day, we're going into that 3 o'clock hour. Well, you saw that shoots up. Not surprised. Why? Because it's doing something that's symmetrical. Dollar index went up into 3 premium arrays. ES went down into the new week opening gap, high, new week opening gap, consequent encroachment. And we're in the lower quadrant of that new week opening gap. At the same time, dollar has dug into its buy side liquidity. It went through that liquidity void where there's an actual gap yesterday evening when it started trading again. And the buy side liquidity at the 45 level or something to that effect. 0.45, 10245, I think it was. It went through all three of them rather. And now we went to what? Time. So things are going to happen around certain times of the day. So you're constantly balancing what you're reading, interpreting from price delivery, and other markets that are important. So if the dollar's going up, that's what? That's risk off. It's going up to what? Into liquidity. 3 premium arrays was traded into. And then we did that at a time of day where it can do what? Price in the daily range extreme, high or low. What's it been doing since the afternoon? Trading lower. It went completely down through the opening range gap and through it, taking out the low of yesterday. Now we're trading at 3 o'clock. Final hour trading. We've already made a run below the low yesterday. So what's it likely to do? Draw back on those individuals that have been doing what? Making money. That's what a macro does. It rolls against whoever's been profitable right now, or it completes a higher time frame array. So in other words, if the morning session is rolling higher, the macro will spool, send price up into the higher time frame array. 950, 1010, 1050, 1110. That's it. Simple. But you don't understand what simple means because you're new at what we're doing here. So that's the reason why I tell everyone to learn how to do this, you have to give me a year. And then you will see a full calendar year. You'll see the seasonal impacts that causes these major fluctuations, or what I call a quarterly shift, where we have major macro changes in the tide of direction in price action. And then you find what that is and you try to get in sync with that and you mine that. You try to work within that. So in other words, if we're looking at a quarterly shift, in other words, we're looking at 2 to 3 months of price movement on a daily chart and weekly chart to a higher time frame array, higher or lower. If we identify what we're in, bearish or bullish, you're going to really try to focus in on the weeks that are likely to expand on that weekly candle in that quarterly shift's direction. So we're going from a higher time frame to a lower time frame with the context of a quarterly shift, seasonal tendency, weekly range expansion in the direction of that seasonal tendency. That's when you're going to do the highest leverage. Whatever your maximum leverage is, those are those instances where you do that. You don't want to do it when, if your analysis on the higher time frame, weekly and daily, saying that we're bearish for the next 2 to 3 months. We're expecting prices to gravitate lower, okay? You may do your analysis and say, okay, well, we've been going down for a little bit, and now this weekly candle could expand higher. You don't want to do your largest leverage or risk the most that you would normally do as a high-end leverage in that instance, because you're going against your quarterly shift in the seasonal tendency. So you're not gambling. You're taking the trade, but you're limiting your exposure to risk based on your higher time frame macro analysis. And all these things come together. And then when you have the market finish its expansion against the quarterly shift, whatever your seasonal tendency is, for the next 2 to 3 months analysis, that's weekly and daily chart driven. Then if you have something that's going to expand on the weekly chart that's in that same direction of the higher time frame monthly and weekly chart, now you're in the movement or expectation of that quarterly shift being bearish. Now you're expecting the next week, when you're doing analysis on Sunday or Saturday before the market opens up, you're expecting that weekly candle to expand lower. What are you going to do in those instances? You're going to use potentially your largest leverage, or do what? Pyramid. When don't you pyramid ICT? When it goes against the higher time frame order flow or a quarterly shift. Then I just do simple get in, do my position, get out, be done with it. You don't want to push violently with your equity trying to increase it when it's going against the macro order flow. This 2 to 3 month higher time frame seasonal tendency that we were trying to discern. If you know that you're going against that, why would you risk more? Why would you push your account? Because the chances of it delivering is what? Not as high and with low resistance as it would be if you were in a 2 to 3 month higher time frame bearish market. You're expecting seasonal tendencies to send it lower and then waiting for the next weekly candle that you are likely to see it expand lower. So therefore, you're trying to go short. Everything is framing a idea that you're trying to build a position going short with everything in your favor going down. Then you can do pyramiding. Then you can build your positions larger and you can hold on to those positions longer and not take partials so quickly or that much off as your first partial. See how there's a graduated understanding that all these things come together and it's a beautiful tapestry, but you can't learn it all just because I sit down with you and spend hours. There's a lot of other things that have to be understood. And that's what I mean when I say you can't have these expectations sitting down like that young man in the parable of the Jade Master. Yes, it's not a true story, but I love that story because it teaches that when a student thinks they're ready and they go to someone that is equipped to teach them, they go there with the expectation that they know how to be taught, they know how to be trained or taught how to do it. So who's the master there? They're pretending to be the master. But the master knows that this is how everybody comes to the master. This is how it is. You come to the instructor thinking that you know how you're supposed to be taught and trained. No, 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 don't teach me this. This is how I want you to teach me. How do you know the benefits of that? If you don't know something, how can you say, teach me it this way? Makes no sense. That's a person that's not in a position to be trained. They're unteachable at that moment. And that's what those exercises and those drills that the Jade Master puts that young man through. Makes him do chores, talks to him about things that are outside the topic of Jade. I'm doing the same thing many times in these lectures because I'm teaching you to do what? Build discipline, build patience. You're learning everything you are here to learn. I'm not wasting your time, but I'm also fortifying your understanding. I'm presenting things that you're going to lean on when you start pushing real buttons. And when you get in those real thick moments of, oh boy, I'm really in it now. What are you going to remember? You're going to remember all these discussions. My voice is going to pop in your head and it's going to be like, oh shit, that makes sense now. He talked about this. This is what I'm supposed to do. I remember he said this is what usually happens. So just submit to this idea and let's see what happens. Instead of, oh man, what am I supposed to do? The analogy earlier, where you get into a trade, you don't have a profit target put in, and it blows up in your favor, and you don't know what to do. That's a terrible feeling. It's a good problem to have, don't get me wrong, but it's a terrible feeling because you're making money and you're frozen in confusion, panic, and bewilderment. Like you don't know what to do. How unfortunate. How unfortunate for an individual to end up in that condition. And yet it happens many times. And those are the same instances that you've done that with your demo account. And you think that that is the invitation for you to start trading with real money. Man, it could happen like that with my funded account. If I can just get lucky to pass my combine, then I can do these trades and might get lucky. And I'll just withdraw my first $5,000. If I could just get $5,000, man, that's all I'm looking for. Who cares? It's worth it if I blow the account after that. I mean, $5,000. There's so many of you that think like that. Be honest. You probably felt like that before. Maybe you don't think that way now. And if you're really honest, brutally honest with yourself and me and the community, you would say so on Twitter right now. Like, yeah, that's exactly what I've contemplated many times. It's worth it for me. It's a couple $100 to get in there. If I blow it, who cares? I can just do a $100 reset. I don't know if that's true, how that works, but I know it's not a full amount of money to pay for it. And you're thinking, oh, well, it's just like the lottery ticket. Whatever the payout is, it's worth it. If it's a couple $1,000s, it's more money than I paid to do the challenge in the combine. And if that's how you're thinking, you're really selling yourself short. Like, why waste your time with that when you can do it the right way? Make 6% on that account, build it up over months, and make 50% in 6 months of whatever that equity base is. If you're doing 100,000 in 6 months, build it up to 50,000. Do your profit split. Boom, there it is. You're done. You're in business now. You have enough money to do your own and still do that funded account. And you're just talking about one account, not like the savages I'm creating, where they're managing 1.2, 1.4, all these crazy ass funded account thresholds they're operating in. They know what they're doing. They know what they're trying to accomplish. They didn't think that way and know what they were doing when they first started. You're learning. You're learning a lot about yourself. You're learning that there is no randomness to these markets. And the truth is, you're probably intimidated by how much you have learned in such a short period of time. It might be creating a scatterbrain feeling where it's information overload. And that's normal. It's absolutely normal. And that's exactly what happened with my paid students. Like, I gave them more content than they can technically digest. Even though it was over the course of an entire year, they were getting every day new content, live streams, and 8 lessons that you see in that core content. Think about that. And I was posting charts, static charts for a while in the forum. I don't do that anymore. So it was too much. But I told them that's what it was going to be like. And not to try to, to cram everything in 1 year, to just relax and let it happen. And every one of my students that are making big money, none of them are coming forward and saying, yep, I figured it out in 9 months, 12 months, a year. It took them time, years, plural. And I'm honest, I've been telling you all that from the beginning. Anybody that's made big money as a trader worth listening to. I'm not talking about people on Twitter. Real big fund manager type level traders. If you had an opportunity to talk to them, they're all going to tell you it's going to take you years to really know how to trade. Can you be profitable less time than that? Yeah, but you're not going to know yourself. You're not going to know your model like the back of your hand. You're not going to know what it is that you're doing. You're not going to be me. I know I can walk into any market environment and I will find a pound of flesh. You don't need to be able to do that. All you need to be able to do is know when your model is going to materialize in price and be there on time when it's supposed to be there. When it's done, close your charts and go about your business. Not, I made money. Let me do it again real quick because it feels good. That's like a drug addict getting its first hit, heroin or cocaine or whatever the first high